Hello and welcome to this very special interview. Joining me today in our series is Vijay Chandok, who is a veteran financial services professional, spent many years in the financial services space. He's the managing director at ICICI Securities. This series is brought to you by Bombay Stock Exchange Investor Protection Fund, and we seek to educate you in what you can do when you're investing in the markets. Thanks very much, Vijay. Always a pleasure talking to you.
Thank you very much, Vivek.
Vijay, one of the concerns that people have always had with investing per se, and especially investing in the markets, is that I need to have a lot of money before I can start investing. Is that a myth which it's time to bust? What according to you is the lowest ticket size with which, if I'm a person starting out in my life with very small savings, that I can invest in the stock market?
Well, we have come a long way, Vivek, since the olden days when things were physical and you needed to invest, for example, in the markets with a minimum lot size that used to be about 100 shares. We have come a long way. Things have become a lot more digital and the unit sizes have become smaller as things have become digital. As a consequence of all this, today, technically speaking, an investor requires very little money to actually invest. He can buy as little as one share or one ETF or an exchange traded sort of a security. So the value of a share could be a single digit number, depending on which share or which stock he decides to buy. Typically, these are either single digit or a double digit kind of a number, so it is not too much. An ETF, for example, could be 40 rupees. A gold ETF, as an example, is a 40 rupee give or take in that kind of a region. So you can technically enter the markets with as little as a very small sum of money. So in an accessibility sense, from a financial accessibility sense, it is virtually accessible to every Indian. However, it is often seen that more successful investors, more successful individuals who have participated in the market think of a market in a slightly more long-term way. Think of the markets as a way to increase their wealth over a period of time. And such people who follow this kind of a route tend to, set aside a portion of their savings. Whatever is their earnings, after the spending, whatever is available for savings, a portion of that is set aside and categorized into what they call as investable surpluses into markets. Some amount of it, they like to keep it in form of deposits in banks. Some amount of it, they like to put it to use in insurance. But there is an amount that some investors like to keep away for investing for wealth creation. And that typically allocates itself into the markets. It is typically advised that, you follow a very prudent method of setting aside what only you can afford after you meet your expenses and after you set aside things that are important from a short-term liquidity point of view and put to work only that portion of your surpluses that you're happy to part for a long period of time. Those are the monies that one should think of putting it into the markets. So the amount is not very large. Typically, you could start off with a very small amount, and as you age, as you become wealthier, as your earnings increase over a period of time, you can keep increasing the allocation to the markets. So that's typically how very successful investors have managed their investments and their life with respect to the markets.
Always a pleasure talking to you, Vijay Chandok. Thank you very much for joining us and sharing your perspective to educate our viewers and investors of this country. Thank you very much.
Thank you, Vivek, and all the best to all the investors and the viewers.
Thank you.